Okay, so I'm Heath. What's going to happen is I am going to make you the host so that you can then share your screen and your video, and you're going to take it away. Heath Walters is the founder of the Walters Way, a proactive method to reduce your taxes up to 47%. That is not a false claim. That is absolutely true. It is, I've seen it work. We were literally working on a case today. He's literally works miracles. We are working with him. We've started multiple businesses together. He is more than just a client and a business partner. He is a friend. I've seen him do amazing things for business owners' tax programs. We're literally going to reinvent the tax and financial services industry together on the back of his advanced tax planning system and our marketing system. So Heath, I'm going to make you the host. Make host. Okay, so you are now the host. Can you share your video? And can you unmute yourself?
I don't know if I can do video yet.
You unmuted yourself.
Okay, so you can hear me. I don't know about video. It's not letting me unclick the video. The host has stopped my video.
I have not. You are the host. I'm not host, so I can't change anything anymore. All right, so you know what? If you just want to share your screen and we can hear you, and we'll go with that.
Okay. Let's give that a shot.
Folks, get ready to take some notes. This is literally, it will blow your mind.
All right. So Seth, for feedback or people that are on there, so we've got 11 in total. Are they going to do questions via the note section?
Yeah, if you guys have questions, make sure you do the chat. Make sure you ask them in the chat box, and I will monitor the chat box and read them to you as we go. And because obviously we have a whole lot more people than this who registered that are going to watch the replay, and then they'll have to email their questions in.
Okay, that's perfect. Okay, all right. Sorry, I don't have my video, but it'll work because my face isn't important on this thing. Right?
Gotta love technology.
All right, let's go do it. All right, so let's go talk about what tax planning is. So I am a CPA, so that everybody knows that I'm not your traditional CPA. I try not to be boring and lame. So we should have a little bit of fun when we talk about this stuff. Some of it will be technical, but for the most part, it should be pretty more illustrative. I think more like a financial advisor, even though I was somehow able to pass the CPA exam. So here we go. Let's go talk about what tax planning is. If a business owner makes $500,000 in a year, they take their standard deductions. Let's talk Section 179 or their home office or the mileage. I, as a CPA, your CPA, no CPA can make a Section 179 any bigger. Either that property, whatever you bought was 100,000 and you can write off 100,000 or not. I can't make 100,000 turn to 200,000. So like I'm nothing special in the traditional sense of tax planning. So if in this scenario, it depends on the state, but it'll average about $150,000 in taxes between federal, state, and payroll. Take a family that's spending about $300,000 a year personally, just on stuff like you can't really write off, like Ferraris and houses. Then you have left 50,000 bucks. All right, that's kind of what the way that people think of tax planning today, and they think of taxes, they think of their CPA. Under the Walters Way, we can't change your income. We can't make it any different. Again, we can't write off a 179 or home office any bigger than what you can. But we focus 100% on the golden leaves. And the golden leaves represent about 400 advanced tax strategies that are out there. They're available. They're just very, very difficult for CPA firms to proactively implement. Their tax preparation firms are designed to take the data that all happened last year and start preparing that and giving us answers with how much money a client owes or how much money they owe to the government. That starts in January for everything that was done in the prior year. All of these golden leaves, generally speaking, are things that are going to happen during the current year. So as we're talking about this, you're thinking about tax deductions for 2019 that you're going to hand right over to your tax preparer to do your returns. And these things need to be in place before they get your returns. We typically see tax rates drop about in half. Again, Seth said it earlier, 47% is the average. Personal spending stays the same because we're not trying to go just put all of your money into a 401k or a pension plan. You're investing in saving shifts. We take the IRS's money, that's 75,000, and we put it into your pocket. Shows your tax savings that's there. What's neat about that is if you think about Warren Buffett, he put a challenge out to business owners and said he'd pay $1 million to a business owner that said that he actually paid more money in taxes than his employees. And he had said most business owners pay about 15%. So when you look at what happened here, and I learned that after I learned how to do tax planning, so this wasn't, I was chasing after Warren Buffett, but when you look at 75,000 in taxes on the same income, we're right there at that 15% effective rate. We've been able to average that number over the last, like, I don't know, 5 or 8 years. So it's been a little bit, but we're kind of in alignment with what people expect. And when they think of people of Mitt Romney's stature or Donald Trump or Warren Buffett. So how do we do that? I'm going to walk you through a couple slides of strategies. So first and foremost, when we talk about the way that companies operate, most CPAs will tell most clients, and I could probably show a raise of hands and go find out how many S Corps are in here. But if we had 37 people, I probably have 30 or 35 S Corps. We're all in the financial services industry. That's what the CPA is going to tell you is going to save you the most money, which is absolutely correct. S Corps are going to save you a lot of money. But what the CPAs generally don't tell you is that C Corps have advantages. Partnerships have advantages. Single member LLCs have advantages. So why are we limiting ourselves to only taking the strengths of one company type? What happens if we follow this structure that we have on the table here that has been used in the medical industry in the advanced side for quite a few years? And I'll kind of talk through to you why we would do this. We take a partnership. Partnerships are allowed to move money from company to company or partner to partner, as long as the partners agree that that's what they want to do. An S Corp can't do that, a C Corp can't do that. So instead of you take a partner himself, like an individual that owns into a partnership, we look at it and say, why can't we have a partnership or an S Corp or a C Corp that this partner owns his interest in that partnership? Why is that important? So let's go take a business that's making $100,000 and you've got 2 partners. If one partner says, hey, I would like to go buy a $100,000 car this year, the partnership goes, you can't buy that. That's all of our money. It's 100% of our money. And that would go to all one person. So one person would get $100,000 in a new car. One person would get 0. So what happens in that structure is they're not able to write that car off, period, because it's not fair between the 2 partners. If on the flip side, we had this structure here where each of the 2 partners, let's just call it one as a partnership, one as an S Corp. Partner A over here in his partnership gets $50,000. The S Corp gets $50,000. This guy says, hey, I'm going to go buy the $100,000 car. So I'm going to take the write-off against my 50 grand of income. This guy goes, nope, I want to keep my 50 grand. I don't want to have to go buy a car. So we got the money down to the 2 of them, but this guy took the bigger deduction and this guy didn't. He kept the cash, paid some tax on it, but he got his money. This structure allows you to move money amongst different companies, but still allow each partner to, in this partnership, do their cars, to hire their children, do all the stuff like that. When we go through and make changes in these corporate structures, we typically will find that businesses are missing tax deductions. They don't know how to pick up the deductions of a C Corp or how to save self-employment tax on their kids in a single member LLC. So it's a combination of a lot of things that we're doing here, but that picks up missing deductions. Next, we do a thing called income shifting. On the previous screen, we talked about that 15%. So tax planners are looking for areas within tax law that we're allowed to pay 15%. Well, if we hire our kids, the first $12,000 that we pay them is 0. If we have to pay self-employment tax, it's 15. So even worst case scenario, we only paid 15%. We lowered and wrote off 40%, let's call it, for us as the owner, and then our kids are going to pay 15%. That's called income shifting. We can do that to our parents just as well. If we're supporting our parents, that means that they don't have much income and don't have much money. So instead of giving them money because we're supporting them, then we are going to hire them or give leaseback strategies or other ways that we can shift money over to those parents for them to pay taxes at pretty much 0% because they had no income bring them $24,000. Now they write all that off. They don't pay tax on it. After we do that, then we go look at some more advanced strategies. Tax credits are a great thing. Seth and I just this morning were talking about tax credits for numerous clients, and even W-2 clients that have absolutely no idea tax credits are available to regular.
Just briefly, can you explain the difference between a tax deduction and a tax credit? Because I didn't know it until I, learned it.
Got it. So if you make $100,000 a year, and I come in and give you a $100,000 tax deduction, your income is going to go from 100,000 to zero. Your taxable income goes down. That $100,000 person is going to pay about 10 grand in taxes. On the flip side, if we just gave you a tax credit, your income would be the same. You still make $100,000, but the government gives you, if it were a $100,000 credit, the government's going to give you $100,000 to apply to your tax return. Well, you only paid 10 grand in tax, so we're going to take that $100,000, use 10,000 of it today, and then take 10,000 every single year for the next 9 years. So the difference is, if I gave you a bigger example, so if you went from 500 to 400, that's going to save a person about $40,000 in taxes. If we give you a $100,000 tax credit, it's going to save you actually $100,000 in taxes.
So it's a dollar for dollar reduction of the actual tax liability owed.
Correct. Not a dollar for dollar at a percentage tax rate. Right. So a tax deduction would be a 401k or a pension or writing off your house. Like that's a tax deduction. So you went from 100,000 to 90,000, and you still are going to pay taxes on that. A tax credit is when the government says, "Hey, you owed $100,000. We're just going to give the $100,000 right to you, regardless of what you wrote off." Well, tax credits are actually available to ordinary people when you know how to use them and how to find them and which vendors and who to call, and then how to apply them on the tax return. There's also things with charitable trusts. There's property trust, and then there's conservation easements. These are much more advanced in their making. It takes CPAs a much longer time. I mean, like when we learn about a tax credit, it takes us 6 months to get through how they work. How do we calculate it? How do we explain it to people? Because they're complicated. So it takes the CPAs a long time to learn these. Once we get it, they're extremely powerful. Not every client has those. Not every client needs those. And some might need 1 or 2, or some might need all 4. We don't know until we see it. But once you start making north of 300,000, then most people can utilize some form of one of those advanced techniques. Once we go into the very next stage, and we don't have to do this, but we generally do, we take all of the money. So I'm gonna back up the screen real quick. I'm gonna go back into here. So if we go look at step number 1, we changed some companies. Step 2, we took some tax deductions. Step 3, we did some income shifting. So we took it off our tax return and we shipped it to our kids who don't pay tax, or shipped to our parents. We go to number 4 and we say, government, give us a bunch of tax money. Or give us some bigger write-offs, right? What we did in steps 1 through 4 that whole time is we stacked a whole bunch of different tax strategies together to give you a whole bunch of money and a lot of tax savings. Then we take all of that money and now we go put that into a saving strategy. All sorts of different savings basics like 401ks or IRAs. We could go pensions, which we can do $500,000 in. We do C Corps, which is unlimited. Move money to our kids. We can even own our own insurance company, and that's about $2.3 million in write-offs. So really big numbers. We got a big wide range for clients that very few can actually out-earn these potentials that you have here. Because if you just did a combination of a pension and a captive, that's about $2.8 million in write-offs. And I don't know about you guys, but I don't find too many clients that are making probably $4 million a year that can out-earn this. We have all sorts of room to do write-offs. And remember, we didn't change the client's lifestyle. We didn't change anything that they're doing. All we did was took the government's money and shifted it over into our little saving strategy. Well, once we put it in that saving strategy, that creates another tax deduction, which saves us more taxes. Well, what happens when we take the more taxes we just saved to put them into our little savings vehicle again? which then saves another taxes so that we do it again. Well, it creates this cycle that as a tax planner, when we can look at next year's liability and this year's cash flow, we can actually calculate what is the optimum amount of money to put into this to play the balance between the taxes and the cash flow. We do have a lot of financial advisors on this one. So on the backside, we're looking at ways that we can pull money back out. Our goal here is, even though we are creating real tax reduction strategies, we don't want to just pay full tax on all these saving strategies that we did up here. We want to be able to pull it out at a lower tax rate. So we're baking inside of these strategies, life insurance or Roth conversion strategies, or putting tax credits while we do Roth conversions, like all sorts of things that we're kind of baking in the middle there for the retirement planning, which is not what us as the tax planners do. We do really well with taking people that are making money, give them all these tax deductions, save them a bunch of money, and hand them right over to the financial advisor and go, here, go do income planning. We can do the calculations for you. We can support how much money you roll from a 401k into life insurance or annuities or whatever that is. We can do all the tax calcs, but we don't do all of the retirement planning. That's not what we do. So now what I'm gonna do is I'm gonna lead this over to two other areas. And these are some things that are a little bit more, this next one is more specific to a lot of the advisors that are on the call, but this applies to our clients too. If we look at qualified business income, that is a tax deduction that the government put in place in 2018 that allows any flow-through income, which means if you're running a company, if you have an S corp, and the company makes $200,000, you paid yourself $100 in salary, and you took $100,000 as a profit. Well, qualified business income is that other 100. It's the profits from your company. Doesn't apply to a C corp, but it's S corps and partnerships and Schedule Cs. So if you've got business profit, you get a tax deduction for that, 20% of that money. So if you make $100,000 in profits, you get to write off 20 grand automatically. It's not a credit, but it's a write-off. So there's a phase out period. If your taxable income is between, it's actually supposed to be 320. So sorry, 320 to $420,000. That's taxable income. Then you will phase out of that 20% tax deduction for a technical term called specified service business. What the heck does all of this mean? Well, if you're a doctor, a dentist, surgeon, CPA, financial advisor, then you will be classified as a specified service business. So if you're in these areas, of which pretty much all of us on this call are, and we make more than 320,000, sorry for that miscalc there, but we make more than $320,000, then we lose this 20% tax deduction. Like, oh man, why did the government do that to us? There's a couple of exceptions in here. One is you are also limited to 50% of payroll. So it works out well if you're making money and you're paying yourself payroll tax, then you can do this. There's two specific fields that there are also exceptions for that. I think it came down to the political side of the negotiating after they put this tax law into play. But engineers are treated not like a specified service business, and insurance agents. We actually did a tax plan for a financial advisor that he filed his 2018 tax returns, and he included all of his insurance income and all of his assets under management income into one pool. And he'd made over $315,000, so he lost his 20% deduction. Well, what the CPA did not do was separately allocate that insurance income from the assets under management income and take a tax deduction for that insurance money. We went in, amended the tax return, and that was a $35,000 tax savings for him, not a tax deduction, actual tax savings, like discounted his tax bill by $35,000 by aligning that insurance income with that 20% deduction.
That is absolutely insane. So advisors, if you're right, you're doing RIA business and insurance business, and they're not separated on your tax return and counted differently, they absolutely should be. And that tip alone is probably worth a large chunk of money to you to go implement.
Mm-hmm. Yep, absolutely. You can ask your CPA about it. They'll probably understand it. They probably didn't do anything to go help you get it, but it's there and it's available. So I'm gonna go on to the next slide.
Yeah,
Seth, I've only got
continue.
one more slide to go, by the way. So we're gonna talk about the next little step, which is what to do with a business sale. I actually got this phone call in today, this morning as I got up. It was an advisor that we had met a year ago, and he had a client that called him and said, "Hey, we're getting ready to sell our business. What do I do?" And they're like, "Well, call Heath's firm. They know what to do in this." So I wish we had all of our chats on. I like to ask the question, how many in here think that they have to pay taxes when they sell a business? You can't see me, I'm laughing. You do and you don't. Per tax law, I'm going to walk you through what we see as a typical case for a business sale. This applies to CPAs, it applies to financial advisors, it applies to all of our clients. Typically, especially in the services industry, we'll see, I'm taking an example here, that somebody's making $2 million or getting paid $2 million to buy their business, and they have an earnout, which means they're paid salary, they're paid rent, they're paid all sorts of other things for the next coming years. When this happens, they get stuck with 4 different types of taxes. Capital gains, which we think of, all right, we sold the business, it's $2 million. Don't know what our basis is in it, but let's just assume that everybody wrote it off, which most do. But we're going to pay capital gains taxes on it. From the surface, that's a 15% tax. Additional Medicare means that, hey, by the way, you made too much money, so you could be paying 3.8% of another tax on top of this number. We can have state taxes of 0% to 13% in California, and then ordinary income. Ordinary income applies over to this amount. Because when somebody does a buyout or an earnout, what they're doing is they're hiring you to come back in. So this $500,000 on this side is then taxed again at ordinary income. And this is actually an example of a case we have done this year. So this is kind of real. So the taxes, the way that this works, that $2 million of income from the sale is going to generate, for just an average state, about $550,000 in taxes. Earlier we said, hey, it's 15%. All right, that's like 300 grand. So that's what we're thinking, is that it's going to be a $300,000 tax bill. But we forget about additional Medicare taxes, state taxes, and capital gain tax is zero, from $0 to $75,000, as long as your income is down that low. Then it goes to 15% all the way up to 460,000, and then 460 up, it's now at 20%. So you can be stuck with 20% plus 4% plus the state taxes. So you actually can get pretty high on that number. So it's much higher than what a lot of people are expecting to be paying. Next, that $150,000, if we just went back 2 slides, you would see 500,000 of income. Ordinary income is about 150 grand in taxes. So this business sale actually creates about 700 grand worth of taxation. So it leaves a take home, after all is said and done, 1.8 million. When we come in, income's the same. Those deductions are all the same. We find that our tax bill, including fees, runs somewhere between 200,000 and 400,000. And I didn't run another screen like I did the last one when we talk about how we do that, because with the business sale, everything's very different and customized. But the main points to that are, there are ways that we can either defer that tax out like forever. There are ways for us to write those taxes off. There are ways for us to gift that. There are all sorts of ways for us to maneuver. There are ways for us to recategorize that $500,000 earnout so that it doesn't all come out as ordinary income tax. That 500K is what we do that's what we do every single day. We're just following the same systems we do. Someone just happens to be selling it. but the dynamics change when you add a really big number in the front. This is where you need to have your proactive tax planning team. We even have to bring attorneys in. Like, we can't even do all this ourselves. We have to go to the big dog attorneys. And the attorneys, what they're going to do is they're going to help us figure out what strategy works. Professional services, financial advisors, RIAs, CPAs, we can't use about half of the strategies because no one is allowed to own our companies but ourselves. Where someone that is running a construction company, well, they have a lot more options because there are more people can own construction companies than just that licensed person. So there's lots of ways for us to be able to get there. There's lots of ways to skin the cat, but we typically see when that $2 million comes in that we're either going to report 1 million or we're going to report 0 million on that return by the time that we're done with this. A couple caveats are the most important thing: at least 3 months, preferably 6 to 12 months before the client is going to sell this, that they are connected with a tax planner. If the client calls you and says, hey, I've got a letter of intent, it puts a massive amount of pressure on our team to try to make it a legit legal tax saving strategy. That's just very, very, very difficult to pull off. It can be done. We'll tell you if it cannot, but you talk with your clients that run businesses before they go to sell it, and then you partner up a while before they go, and most importantly, before the letter of intent is ever signed. That's the most important time frame. So you have your clients call you before letter of intent, and then we can make all of that stuff happen. Otherwise, every day you wait is another dollar you're giving back to the government. So I'm kind of about done, I think, Seth.
Well,
I forgot about that. I forgot about the fact that when I pulled the effective tax rate, it's actually pretty neat because it ran a little bit above half of a little bit above 50% reduction, which is a little bit higher than what we do. But a lot of people wouldn't think that, hey, I'm selling a business and your effective tax rate's 28%. Like, that's 15. No. So these numbers were actually pulled. We ran a 5-year projection from very, very, very similar numbers. And these are actually the numbers. That's actually what came out for a sale in North Carolina. The 700 was real. So that shows you kind of the difference between the before and after. And most importantly, you do have to hire advanced planners. You got to hire really sophisticated attorneys, and there's a lot of cost in those. But when you compare what you're saving here to what we're getting, it makes sense because that's after fees and expenses.
That is absolutely incredible. Obviously, that was a lot of content in a very short period of time in terms of advanced tax strategies that we can be using as business owners and that we should be using to our clients, because we probably have a lot of clients who meet some of these criteria, especially with our affluent business owner client base, or when you were talking about tax credits for W-2 employees, that could also be a huge add-on to our practice. So for our folks who are watching and want to learn more about this, how is the best way for them to get in touch with you and your team to start kind of either applying this for themselves or sending clients your way?
Well, if they go onto our website, you can email us or email me direct, heath@thewaltersway.com. You go right to our website and find our contact info there. And once you call us, we'll send you a list of documents and things that we would need to be able to look at to walk you through that.
And like I said, he's doing this for me. He's doing this for my clients. We were working on a case today. We are in the process of reinventing the accounting industry as well, to shift it as a whole towards more of what Heath is doing on the advanced tax planning side. So we are super excited that you joined us for this initial session. There will be many more to follow as we scale this process to tax planners, accountants, and financial advisors nationwide. Thank you, everybody, for joining us for the advanced tax planning session. Heath, thank you so much for joining us.
Thanks, Seth. That was great. So if anybody's got any questions, just reach out to us. see what we can get through. This stuff is very real, by the way, guys, and nobody's gone to jail, so we're not getting in trouble. We're just I like to say we're smarter than a fifth grader, and we know what we're doing on this stuff. So you'll be safe.
Yes, I also wanted to comment that neither Heath nor I looks good in orange, and everything he is doing is kosher and blessed by the IRS and council, so that you and your clients can rest assured that everything they are doing is above board, legit, and will stand up under an audit if it should happen.
Yep.
All right.
Got it.